there's kind of two main types of recessions. One, in a classic like developed market recession, most people are not impacted. Like if the unemployment rate goes from 4% to 9%, something like 5% of people were impacted. They lost their jobs, and most people were not impacted almost at all, other than maybe being a little bit more concerned about their jobs and therefore not getting great raises that year. There's very minor impact for most people, but catastrophic impacts for a few people. Whereas, like for example, in Egypt, for example, they went through this kind of multi-year currency crisis. When you look at energy, like electricity consumption per capita, it's down, which is generally a really bad sign, like in terms of fundamental growth. Um, but it's not really like an unemployment cycle per se. It's not like the same type of this kind of credit cycle or this unemployment cycle. It's more like everybody got a little bit poorer. Like everybody can has more trouble going on international flights or buying foreign cars or buying computers, like any sort of imports or anything that involves outs or like food costs, fuel costs. Everybody kind of got this like haircut, or at least most people did. So it was a more dispersed type of recession. And so when you look at like 2022, the misery index spiked in the U.S. And it has that kind of inbuilt kind of debasement protection into it. So that's really how I've been gearing toward it. The only concern I'd have is, there are like equity valuations can reach such height that even a certain debasement rate starts to make it so that they're not really going to compensate you. So I'm not blind to valuation when I try to be equity focused, and instead I try to shift around that equity focus to avoid areas that I perceive as potentially being a bubble. So like right now, I think there's a little bit too much emphasis on quality stocks. Depends on the stock. Mike Green would go into how like the passive bubble, for example. There's certain areas that I find a little bit concerning. And they have kind of recursive investor demand. But outside of a couple pockets, yeah, I'm more equity focused.
Hey everyone, hope you're enjoying today's interview. As you may know, investors and advisors alike are rethinking the 60/40 portfolio, and many of them are turning to commodities for diversification. But for most investors, getting true exposure to commodities can be difficult. Direct ownership of futures contracts isn't suited for many investors, and they aren't even available in most brokerage accounts. And commodity equities are just that, equities. Finally, there's a solution. 2gram's US agricultural ETF
To kind of keep up. So it's really about that managing of not being that kind of perma bear on U.S. mega cap stuff, and just basically saying, you want to watch out for risk and maybe look elsewhere where there's a couple low hanging fruit that you can pick as well. An analogy I've used is that in the late 90s, everybody was focused on the dot-com bubble, right? Everybody talks about what Cisco was valued at and all that, but Coca-Cola was trading at over 50 times earnings. Walmart was trading at over 50 times earnings. And what happened over the next 10 years was that their fundamentals did fine. These were blue chip stocks that continued to expand globally and make more money, revenue and earnings, but their stocks went nowhere for 10 years because their valuations steadily fell back down to the 20s, or in Walmart's case, even lower for a period of time. So if you cut your valuation in half, but your earnings double, you run nowhere for a decade. And so when I look at companies like Costco, I think this is an amazing company. It's one of the few companies that customers like, shareholders like, and employees like. Usually, you only get like lightning cycle. And the way that I've kind of put it is that you know there's a lot of investors that have been always on the lookout for like this like U.S. to international rotation, for example, um, and it's very easy to be premature on that. But the way I would describe it is that there's certain conditions that at least increase the odds of having one of those rotations. So, for example, back in 2019 was the last time that there was a potential for a rotation because we were going through this like domestic U.S. softening. We started to get a mild rate cut cycle. By the end of the year, we had the repo spike, and then we went back to balance sheet increases because of that. And this was kind of setting the stage, I think, for a potential rotation. But then COVID came along and everything, kind of blew up, right? So we didn't get that rotation, and everything is kind of shifted even more to one side of the boat. So all this global capital stuffed into the US, and we're going through another rate cutting cycle. So it's the first kind of serious time in 5 years where there's at least a potential for rotation. I think the odds are higher this time. Doesn't mean it's guaranteed. And I've been watching, kind of news and some of these other areas. Rotation, we look at valuations, when you look at this kind of easing cycle, when you look at the willingness for certain other economies to stimulate. Um, but we don't have like the sheer like demographics and build out of China, that we had back then, like in the early 2000s. There's not really any country that can replace that. I mean, India's pretty strong, but it's not like that. So I think it's more of a moderate type of cycle is how my base case would be. So I'm fairly bullish on emerging markets. I think you have to manage your position size somewhat. And around the margins, there's already been some rotations. Like I've pointed out that if you look at Latin American equities on a total return basis, because they do pay higher dividends on average, they bottomed versus U.S. stocks in like late 2021, and since then it's kind of been chopping sideways. And they went back to underperforming, but they haven't gotten to like lower lows on that total return dividend adjusted basis. Maybe they will, maybe they won't, but basically that's already been like a multi-year period of no longer underperforming. The rest of the emerging markets were weighed down by particularly bad performance out of Chinese equities. As a sports term for basically when the game's effectively over, but and all the good players are swapped out, but they're still playing, and the game sucks now. There's also really kind of clever ways to criticize the government by basically people saying, "Hey, remember this like Chinese emperor from the 1400s and the mistakes he made?" And it's like clearly it's kind of just it's a good way to get around algorithms or have plausible deniability rather than saying, "Hey, the current president's bad" or whatever, which is you get in trouble for. Um, and so there was increasing dissatisfaction, and they were increasingly at risk of not hitting their own self-imposed growth targets the way that they choose to measure them. And so basically they kind of have multiple priorities right now because China wants to internationalize their bond market. So they want to have a credible currency and bond market that their trading partners can hold for periods of time and expect that the
the Chinese economy is going to improve because of stimulus measures, and investor appetite for stocks is going to improve because the central bank is blessing investment of the stock market and is putting a floor on the real estate market. There's also the more short-term speculative flow of everyone was short Chinese equities or underweight Chinese equities, and this is a drastic change in sentiment. Do you have a gut feeling or a sense that you feel an inclination that you feel comfortable sharing about just how offsides the global investment community was? I mean, the headline on Bloomberg.com now is that quant funds that were short Chinese index futures are getting margin calls. Now, interestingly, the actual Chinese stock market today and the U.S. markets are actually down slightly 1%. But this does appear, Lyn, as like in March 2020, I believe the bottom of the S&P 500 was March 23rd. And from that vicious sell-off, that really true was very vicious, you had a ferocious rally upwards that lasted until the high in early January 2022. But for most of the first month or first few months of that rally, so many commentators
it's a leverage in there. And it's just more opaque than I like as someone who's not going to specialize in China. There's certain opaque areas that I just don't, I don't have an edge to go into. I've been preferring to play it from the top down, which is to either own the index or own some of those big tech stocks or big mega cap stocks that you mentioned. They're the ones that I think you can trust the numbers more. Those are the ones that if all these foreign investors consider China uninvestable and then start to consider it marginally investable again, they're the ones that they're going to go in and buy. Um, Now, domestic confidence is a different matter, right? I mean, if they're still if consumers are still suffering some wealth effect issues from their real estate going down, they might not have a lot of capital to deploy into stocks, which is now offset by the fact that the government wants to directly stimulate stock. What people generally have in developed countries. So I think that as avoiding major fumbles, that there's still growth opportunity there, just not at the same speed that investors became accustomed to until a few years ago. In addition, the like Japan had, I mean, Japan's bubble in the late '80s was like the biggest bubble as a percentage of any one economy like ever. Um, like their stock market capitalization surpassed the U.S. during that bubble. Their like Schiller PE, their CAPE ratio was like double what we had in the dot com bubble. And then they had a real estate sector bubble at the same time. China, their bubble was mostly focused on the real estate sector. They never really had a stock bubble. They weren't, at their peak, they weren't super cheap, but they weren't really in a bubble. And it was mostly just a real estate and leverage bubble, which they're working through. And they don't really have that equity bubble along with it. Now, if anything, they're really cheap. And so the combination of valuation differences and American streets, you see them on streets in Cairo or streets in Brazil, or they're selling to other BRICS nations, they're selling to emerging market nations, and they are selling at a pretty low price for decent quality. And so when you go to those markets where a lot of people like ride mopeds, they can now upgrade to cars that are cheaper than anything you'll find in the U.S. But that function pretty well. And it's kind of like how South Korea like increase the quality spectrum over time for their cars. I think we're going to see a similar cycle for China. And I think another industry that's behind that, but maybe is still to come, is their aviation industry. So they have like 15 years in development for their first commercial airplane. Comac is their company.
U.S. Treasuries as the U.S. government continues to be a very large borrower.
So China's treasury holdings peaked in something like 2013 or 2014. They've gone steadily down. They even announced it at the time and basically said it's no longer in our interest to keep accumulating these. They started to instead invest more into like Belt and Road Initiative type stuff, marginally increase their gold holdings. Some people have reasonable speculation that their gold holdings are higher than they stated, but that a lot of that just could be private sector buying. Either way, there's a lot of gold in China. Basically, I think that they're going to hold a lot of assets aside from treasuries. I don't, not that the treasury is necessarily going to go to zero, but that they just don't want this big, gigantic kind of unilateral exposure to, um, the U.S. government. Um, I think they're gonna swap back and forth to other assets. You weight things toward like just making it like prioritize holding treasuries, and entities that kind of hold them on leverage do okay. But if you're just like a consumer investor, if you're sitting there holding treasuries, I think you're gonna get like devalued over time compared to a lot of other assets that you could be holding.
So your base case, or you think it's more likely that if there's a bad scenario for treasury investors or the treasury market, it is just in underperformance rather than a crisis, and that the actions done to smooth out the crisis and make sure everything goes smoothly, that may result in inflation or underperformance, but that the odds of a true crisis are lower.
Yeah, I think you could have many crises. I mean, we had some mini crises. Like when we had an interview like a year ago, we were talking about like market like characteristics, right? So I think that we basically have higher background inflation, offset by whatever productivity gains we get in AI and things like that. And if you get a ton of productivity and you get monetize fiscal deficits, then it's good for asset prices instead. So instead of it either goes toward consumer prices if you have bottlenecks in energy or manufacturing or services employment, things like that. If you don't get bottlenecks there, it piles into generally financial assets, Bitcoin, gold, high quality stocks, high quality real estate. It piles into those types of things. And so at the end of the day, these long-term bondholders, I think, are going to keep just like their purchasing power is not going to appreciate compared to most other assets you could hold. Now, that doesn't mean that there can be really good trades. If you get like if you know what the exact numbers are, but you have a certain amount of reported spare capacity, and like we mentioned before, I don't think these Chinese stimulus are going to be like shock and awe. These aren't like $1 trillion stimulus coming in. We're not seeing a pivot on the dime. And so I think that this takes time to kind of renew emerging market like energy consumption, for example. So I think that can head in the right direction over time. Meaning like I think you'll see more oil demand because of a stronger global economy, but not necessarily right away. And it kind of comes down to like decisions of Saudi Arabia. So I have to get into like the Saudi mindset to fully answer what CPI is going to do. And I try not to do that. So I think in the intermediate term, I'm kind of mixed on inflation. I think that the structural bias under fiscal dominance is higher average inflation. So I don't really see us returning to the 2010s period of market value versus realized value. So market value is just the market cap, and realized value is kind of like the on-chain cost basis. It's like the value of every coin the last time it was moved. Like what was the price in dollars last time it was moved on chain, which is often when people either send it to an exchange or pulled it from an exchange. Um, and when you get a really big bull market in Bitcoin, you get a really big kind of multiple of market value versus that kind of realized value on chain cost basis. And that tends to presage forward bad returns for a few years and a breakdown in that liquidity correlation because that kind of bubble can unwind and override any sort of liquidity correlations for the next 12 months or so. And right now we're not really in one of those valuation bubbles. There's a pretty normal divide between market value and realized value, and the correlations we found with the logic associated with it. I know that there are some liquidity measures, like Michael Howe, for example, that is it's a broader one, but includes more proprietary data gathering, harder to reproduce. In a perfect world, you'd probably have that. So you'd have like global M2, then probably global like all short duration government debt securities. Um, and then you probably would incorporate some measure of bank tightening or loosening of credit standards, and then private credit. Um, but I think that the benefits start diminishing. You get kind of the 80-20 principle where like if
Yeah.
once you're like 80% of the way there, you're not really like, I never find that indicator is directionally differing from some of these more proprietary ones. It's more around the margins, and that's also why we focus on that valuation component, because we found that having a good enough liquidity indicator and then combining it with
Because there's a crisis, that is bullish for liquidity, global markets, and the global economy. I mean, just how stimulative do you think the Federal Reserve cut will be? I know that in one of your pieces you wrote about how you found it interesting that the China started to stimulate almost immediately after the Federal Reserve began to cut. Like, were they waiting? As well as how effective do you think the cut will be to markets if the 500 basis point of hikes was not as contractionary as people thought? We did not have a recession. Is the 200 to 300 to whatever, how many basis points of cuts we're going to get, is that not going to be that stimulative as well? Or is it? What are your thoughts?
So I've written about the fact that I think the Fed's a little bit overstated. Like the attention on the Fed's a little bit overstated compared to what else we could be focusing on, including like Chinese stimulus, for example. Um, but that it's indirectly important. So, and then to the extent that the U.S. rates go down, they can ease, and then therefore they can take off pressure on their economies. So I think that the it kind of has a pretty wide disbursement effect as the U.S. cuts and all these other central banks cut, especially when you combine that with the fiscal side. So the fact that the U.S. is running these kind of structurally high fiscal deficits, uh, again, gives you that kind of background stimulus. And so it doesn't mean that all areas run hot in real terms, but it generally means that things are pretty hot nominally. And then depending on energy inputs and things like that, you can get decent real performance as well.
The Federal Reserve dot plot projects interest rates on the longer end going down to 2.9%, and the market thinks they might go down as low as 2.8%. Do you have any big disagreement either way about, is the Federal Reserve going to cut more or less than the Federal Reserve has indicated and that the market is currently pricing in?
Not particularly. My view is not to try to second guess the market too much in that area.
And CNBC. In other words, what are you interested and maybe keeping you up at night that you see very few people talking about?
That's a really good question. It's hard to answer because I think yours is one of the few podcasts historically, that does cover a pretty really wide range of things. I think you bring on a really diverse set of guests that all have these different areas of focus. Sometimes I'm happy to see that there's an area that I was focusing on that's not getting attention, and you bring on a guest that like specializes in it, or you bring up someone that like I think there's a topic I wasn't focused on and kind of like put it on my radar. So I actually think it's not the best advice, but you're already doing great in that area. I think you want to have obviously people that can cover China as